Welcome to The Property Planet, a podcast with Simon Howley and Amanda Perrotten of Bell Howley Perrotten, the show all about the tax and legal issues surrounding property ownership, where we discuss everything that affects property investors and developers and go deep into the details to unravel the advice, highlight the traps you can fall into and dispel the myths surrounding property ownership in the UK.
Good morning and welcome to the Property Planet podcast. We specialise in bringing heavyweight experts in their field to answer questions and discuss developments within the industry generally. This morning, we're particularly delighted to welcome Ray McCann to the podcast. Ray's career has spanned 45 years and experience in both international and domestic tax, with previous roles at HMRC, PwC and Pinsent Masons. President of the Chartered Institute of Taxation in 2018, among many other accolades, and crucially oversaw the introduction of DOTAS when he was with HMRC. So good morning, Ray.
Good morning, Amanda. Good morning, Simon. I was quite interested that you like to get tax heavyweights on, but obviously on this occasion you couldn't get one, so you've done it for me. Yeah. No.
Oh, well, one of the, obviously your key areas of expertise in terms of HMRC investigations, regulation, compliance, we've seen a lot since the advent of Spotlight 63, with clients becoming concerned about whether or not what they're doing is legitimate, what HMRC are doing is appropriate. So I wanted to really sort of take listeners back to the beginning, because they'll have seen information on LinkedIn, on websites, on property forums, and obviously as sort of the grandfather of the DOTAS scheme, it'd just be really interesting to hear your views on why HMRC decided to bring that into being and what it stands for, what the implications are, just a general overview. So when people read about a DOTAS number, what does that actually mean?
Yeah. Well, grandfather, you make me feel old, Amanda.
Sorry.
Anyway, well, I am old, but never mind. I think we go back to 2003 before DOTAS actually reared its head. What was the scandal then? The scandal then was just simply that people looked to avoid tax. And it never really went beyond that. There was a little bit of scandal around national insurance contributions because there was a huge effort through readily convertible assets and things like that to try and avoid national insurance contributions. But when you think back, I mean, it's 20 years. Looking back, it actually feels like a time of innocence compared to what we've seen over the last decade or so. And DOTAS, at the end of the day, when it was first enacted, it was simply a mechanism whereby it said to those who were marketing ideas around reducing tax, just tell the Inland Revenue what those plans are, just in very broad outline, so that the revenue can actually then make a judgment as to whether or not it's something it's concerned about. Because at that point in time, ministers were fed up with the fact that the revenue were rolling up, to the Treasury and saying, we've discovered this scheme. It's been going for 2 years, 3 years, 10 years. We think it's costing you quite a lot of money. We want to close it down. And the only answer was always retrospective legislation. And at the time, I was never really keen on the retrospective aspect of it, because I always worked on the basis that by the time the profession had been found out, if I can put it that way, they'd moved on to something else. And if you look at the history of tax avoidance, that's the pattern that you see. As soon as something gets rumbled, they move on to something else. And, employee benefit trusts were huge in the 1990s. As soon as the revenue sort of picked up on them and started giving them a hard time, the bigger firms started to move away from them. Not entirely, but over a period of time, eventually the bigger firms just abandoned them completely. Stamp duty, land tax stuff, the firms that were promoting those moved out of them as soon as it became clear that they were just going to be nothing but hassle. So at the end of the day, all DOTAS required was just tell the revenue, here's an idea that we're marketing to clients. And at that point in 2004, it literally was innocent because it had almost no ramifications. It didn't have what you've got today with accelerated payment notices and all that sort of stuff, and the linkage into the GAR and the general anti-abuse rule and things like that. And yet there was still vehement objection. And at the time, I just found it incredible that, people would sit in front of me and tell me it was too difficult to provide what was being asked for, when what was being asked for was a fraction of what was being provided to the client. And I saw it in particular when I left HMRC in 2006, and I started to actually see what the firms were providing to clients by way of explanation around the planning. I just looked back on the discussions I'd had during 2004 and 2005 with, quite blunt cynicism, really, in terms of, telling me that they couldn't provide this and it was too difficult to do that. And yet I would see planning notes from firms to clients, sometimes 30, 40 pages long. Probably to a lot of the clients, it was just double Dutch. But, to me, as a tax professional, you could see exactly what it was doing. And all DOTAS required was a paragraph, effectively. So there was a huge over-egging at the time by the profession as to how complicated or how difficult it would be to comply with DOTAS. But then when you roll forward, you get to 2024, and we've seen actual scandal after actual scandal after actual scandal. And the last one is the one you alluded to, which is the Property 118 and the less tax for landlords and all that. Now, I mean, as best I can, I've looked at what they are promoting, and they should have disclosed that to HMRC. It's difficult to see how they could justify non-disclosure. And it's really hard to see how they could justify non-disclosure as some sort of, positive attribute.
Yeah. I mean, just taking that point, we've seen some literature that says that it was in-house tax planning, and therefore, so obviously people listening will have gone to these people because they were promoted, the Landlord Investment Show, they sponsored the Landlord Investment Show. They were for all intents and purposes, a very professional, regulated outfit. So in your view, what possible reason could they have had for not disclosing it?
Well, the obvious reason is they would work on the basis that once disclosed, it would just bring a world of grief to them and their clients, because it would inevitably result in some level of HMRC inquiry. I mean, I think a situation where HMRC would have received a disclosure from them and looked at that and thought, well, we think it's fine, we'll just let that go. I don't think that is a conceivable scenario, and I suspect they probably would work on the basis that if they told HMRC what they were planning, HMRC would have taken some kind of action, whether it was an investigation or whether it was recommendation to ministers that the law needed to be tightened up in particular areas. I mean, I know from talking to some people in HMRC that they have welcomed some of the work that Dan Needle has done, because it's shifted the focus within HMRC that there are issues other than disguised remuneration that they need to be concerned about. So it's given a little bit of impetus to HMRC's efforts to try and make sure that in other areas people aren't abusing the tax rules. And to be fair to them, I mean, I've tried. The only point I've commented on publicly that I can recall is this issue about whether it's an in-house arrangement. And no matter what they say, it's just not. Because the minute you have got a professional, and let's give them the benefit of the doubt and say that they are professionals. The minute you've got a professional acting, whether it's a barrister, and a solicitor, a tax advisor, then it ceases to be an in-house arrangement. Unless you're in a position where legal privilege is invoked, in which case the obligation goes on the taxpayer, but it stays a promoted scheme. It doesn't become an in-house arrangement. And I think that's one big mistake that they have made.
So what would qualify as an in-house arrangement? Because, given the number of people that have implemented the planning, what in your view would qualify as an in-house arrangement? What type of thing would be an in-house arrangement?
Well, you and I are pretty expert at what we do. Now, I could sit here and dream up some whizzy scheme to try and avoid some of my income tax. Now, I don't know what it would be. Difficult for me to imagine what it would be. But if I sat here and dreamt up some whizzy little scheme and put it into effect, that would be an in-house arrangement, because I wouldn't be relying upon anybody else. I'd be pretty mad, obviously, to do that. But, I wouldn't be relying on anybody else. So that would be an in-house arrangement. If you had a corporate and the tax people within the corporate identified some little planning opportunity and they did it themselves, and they didn't take advice from counsel or they didn't take advice from an accounting firm, that would be an in-house arrangement. So any situation where you've got somebody advising you is never an in-house arrangement. It's always a promoter-driven bit of planning. Now, it might be, because there is a slight gap in who a promoter is, it might be that someone could sort of slip through that gap. I think it's unlikely, but you can't completely rule it out. But 99.9% of the time, if you have someone who's advising you or helping you with the arrangements, it's never an in-house arrangement. It's always a promoter-driven scheme.
So looking at that, one of the things that has been raised as well is that now they're seeking council's opinion. They've set up this SIS structure, and they're going to seek council's opinion in order to then take this to HMRC, and HMRC will look at it and think, oh my goodness, how could we have got this so wrong? Yes, it's all fine. Is that actually the reality of the process?
Well, that's the way the process is supposed to work. Again, going back, to the innocent days of 2004, at that point in time, because there was a lack of clarity as to how many things would be disclosed to HMRC, and at that point, I was being warned by all sorts of worthies within the tax profession that what I was going to get was haystacks. Patrick Cannon, at one point, I was at a conference with Patrick Cannon, the property barrister, who I'm sure you know, and he cautioned me against reading too much of this. He thought it would be bad for my eyesight a bit, and he compared it to reading porn. And I thought, well, okay, because there was just so much at the time. He said it would be bad for me to sit and read all these disclosures, and everybody was envisaging that it would literally be sackfuls of post arriving at my desk every single day, and the reality was the complete opposite of that. For the first 6 months or so that DOTAS was running, there was a fairly steady number of disclosures coming in. And I think for that first year, it was around 500. But I mean, I had a team of 7 or 8 people. And when you spread 500 across that, it's not actually very much. And if you split that down on a daily basis, it's not very much. And then when you actually think in terms of how much information's in that disclosure, to read each disclosure was just a few minutes work. Thinking about what to do about it, that was the more complicated bit. But I set up this kind of phantom or virtual organisation within HMRC of all the policy and the technical advisors. And these disclosures used to get spread out among these people. So there would be perhaps 100, 200 individuals across the whole of the revenue who were then engaged to look at this stuff. And again, when you spread 500 out amongst that, it's not very much. But after 2005, they largely went off a cliff so far as income tax and so on was concerned. But the way the process was supposed to work is the revenue would then, after a period of time, it would settle down, they'd have a bit more time, and they could decide at that point whether or not to give a number. But the first year planning was, if it came in the door on a DOTAS form, it got a number. And there was no provision at that point in time to remove the number. But it wouldn't necessarily guarantee that the revenue would ever do anything. In most cases, it was expected that it would, because I was relying on the kind of idea that people aren't going to send stuff to the revenue, which is just completely irrelevant. They're going to make a decent effort to try and at least comply. Even if it's reluctant, they're still going to try and comply. So the vast majority of what was coming through the door would be of some kind of interest, either from an inquiry perspective or from a point of view of exposing some real weakness in the legislation that would need to be tightened up. And if you look back to 2004, the pre-budget report in December 2004, there was a whole raft of announcements of things that were going to be closed by legislation. And the same happened early in 2005. There was another announcement with a whole bunch of stuff. And then the paymaster stood up in Parliament in December 2004 and announced that retrospective legislation would be used to combat employment tax schemes if they continued. So that first year, the way the process worked, there was much more kind of certainty around what the outcome would be than going forward. Whereas today, HMRC, if they get a disclosure today, they've got a range of things that they can do. They can, not bother giving a number. They can give a number and then take the number away. They can do all the things that you could do in 2004. They could open an inquiry, or they could change the law, that sort of thing. So to look at we're going to make this disclosure, we don't know what's going to happen. Well, fair enough, but there are a range of things that can happen. And not knowing what's going to happen is not a reason not to disclose. Because ultimately, you are simply putting HMRC on notice on something that they're going to find out about anyway. It's not as if it's going to always stay a secret. It will only stay a secret if people obfuscate and hide the reality from HMRC, because all they're doing is preventing the HMRC finding out until the tax return comes in. And I think the reality of it is the way ministers work. If it became obvious that was widespread, they would change the rules again, because.
But I think we've spoken to could have the opinion, well, we'll just sit around and do nothing and see what happens. And we've said, well, you can't do that. I mean, if you look at the Let's Have Landlords, they know of all of the people anyway that did the planning. It's all been disclosed now to HMRC, so it's on their desks. But it's hard to get across to people that, you know, tax law is very slow, because obviously there's been a case, I think, recently this week that unlimited company SDLT scheme was settled only this week, and that's going back to 2007, that planning. So it's a very slow process. So I think what we're trying to do is convince clients that you can't just do nothing. That's wrong, because at some point there will be a knock on the door. Maybe not this year or next year, but at some point they will catch up with you. Yeah,
and I mean, and everybody who's involved in whether it's Property 118, whether it's less tax for landlords, they have to put something. There has to be something on the tax return. There's going to be something there that's going to flag up to HMRC that these the arrangements that this individual had have now changed, and more likely than not, an inquiry will go out. How have these arrangements changed? And then the planning is uncovered, and inevitably, whether it's right or wrong, tax inspector will always take a dimmer view of something that they find out themselves than something that's put to them. And I mean, since I left HMRC, that's a point I've been really firm with clients. Whenever they've sort of been kind of anxious to try and avoid, telling the taxman anything, that it's far better if you've got something which you are potentially exposed on. It's far better to be on the front foot and to be telling the taxman, this is what I've done, this is why I've done it, and this is the outcome, rather than HMRC sending out a letter, and then before you know where you are, you've got a Schedule 36 notice, and you've got years of dispute with HMRC. I mean, there was a tribunal case last year involving a Schedule 36 notice, and it's been delayed for 2 or 3 years. Now, all the taxpayer has gained is just delay. Now, that might suit some, but doesn't suit most, in my experience. I think most taxpayers like their tax affairs to be wrapped up reasonably quickly. Yeah. It's the exception who are just prepared to dig and just delay and delay and delay.
And I guess with the current HMRC interest rate is, I think, 7.75%. Yeah. So, I mean, that's quite a significant add-on, isn't it? I mean, that's aside from penalties that they could add on. So,
yeah, it's a big add-on when you add it up over a number of years.
Yeah. So with the fact that a number has now been issued for the Property 118 scheme, I'm not sure that I see that as an advantage. I'm not sure that I think that's. I mean, that would suggest that they've now disclosed it to the revenue, and the revenue have issued a number. But then people have also actually got to. So do the people that have used the scheme, do they use that number on their tax return to say that that's what they've used?
They must do, yeah.
Yeah, there's, the way the process works is if you've engaged in a scheme, if you've engaged in tax planning given to you by a promoter, let's try and use a slightly more neutral term. Yeah. You've engaged in tax planning, and the person who has advised you on it gives you a number, a scheme reference number, then you are required to put that scheme reference number on your tax return. You're not required to give any other explanation, and lots of taxpayers do, but the scheme reference number was generally regarded as enough, because the revenue then linked that scheme reference number to the disclosure made by the promoter, and therefore the revenue have got a good idea as to what planning you've actually done. Yeah. And why is that important? Because it gives the revenue a measure of how many individuals have got involved, or how many corporates have got involved in a particular type of planning. Broadly, how much tax is at stake, so that they can then make a judgment as to whether or not they're looking at something that can be dealt with through the inquiry process, or something that needs a legislative change. And if a scheme reference number shows it's got 10 users and a few £100,000 involved, it's incredibly unlikely that the revenue would ever consider putting to ministers that the law needs to be changed. But they may still open an inquiry. So the way DOTAS works, and the way it works internally within the revenue, the numbers, etc., and compliance with that process is important, both from the viewpoint of allowing the revenue to properly target its resources, but also to make judgments as to whether or not there are things going on within the tax code that need to be fixed. And we've seen that. We've seen it less in recent years, I think, or certainly it's been advertised less in recent years that legislative changes have been informed by DOTAS. But again, in 2005 and 2006, there was a lot of emphasis put on when statements were made that we're changing the law for this reason, and it's been, the change has been informed by disclosures made under the DOTAS regime.
Yeah. And so then that deals with kind of one side of the coin. And then on the other side, you've got how the sector is actually regulated in order to put together. I mean, there was a lot of discussion about, you know, who is it that's promoting these sorts of schemes, and do they state that it's an in-house scheme because promotion is frowned upon or unlawful or breaching of the rules, or what are the rules? So how, you know, I mean, could I just set myself up? I mean, I was looking at this, Dan Needles posted, and he's issued this, it's an email that somebody's sent, and it basically says about, you know, how you should be in association with property advice specialists, and it names them, and then it talks about their structures. So if you're on the receiving end of this, and this is generally lay people that are on the receiving end of this, so they're going to be quite reliant on the efficacy of what somebody's emailing them, surely. So then how do we look at the regulation of the industry as a whole that potentially enables something to go out into the marketplace that is wholly wrong, actually, in some cases? I think we've looked at some of the suggestions or some of the documentation that just looks as if somebody that has no specialist knowledge maybe has drafted something.
I mean, it's incredibly difficult from the viewpoint of the taxpayer to see through who is advising them. Now, that's not to say that there aren't things. I mean, taxpayers do have responsibility to ensure that their financial affairs are in proper order. And I suppose if you compare it to a taxpayer who goes out to buy a property with the intention of letting that property in the first place, they're going to take care to make sure that, you know, the people who are advising, the lawyers who are acting for them, and the estate agents and all that, you know, that they're all up to scratch. And, you know, even when we're just selling our own home, we do put a fair bit of diligence into trying to find an estate agent who, you know, is high quality but reasonably affordable, good quality lawyer, all that sort of stuff. When it comes to tax, all that seems to just go completely out the door. And it's one of the great mysteries of life as to why, when it comes to tax, people's eyes seem to glaze over and all they seem to hear is the tax saving. And you get people who come along. In the whole time since I left HMRC, no one has ever asked me if I'm qualified to do what I do. Yeah. Now, to some extent, given when I was in PwC and Pinsent Masons and latterly Joseph Haig Aronson and Charter Tax, they're all recognised firms. You know, they've all got glossy paper and so on, and I don't think anyone really needs an introduction to PwC. I mean, I think the name just rings across the globe as being a major accounting firm. So to some extent, it's kind of understandable that, you know, clients of PwC are not going to ask me if I'm qualified to do a particular thing. Yeah. But, you know, we have to beware the guy in the pub who's giving out tax advice. I mean, I was in the pub, I got berated by the guy in the pub one night years ago because I didn't know what the personal allowance was. And he started going on to me about what a rubbish tax expert you are. You don't even know what the personal allowance is. And I thought, well, I'm not absolutely sure what it is. You know, yeah. Even today, I think it's what, 12,570, something like that. But back then, no idea. But it's hard for individual taxpayers to look at who's advising them and to sort of smell a rat, if we can put it in those kind of terms, because of the way it's presented. It's all glossy. More often than not, it's very glossy. Property 118. Less tax for landlords, they all look very glossy. They've got nice websites and all that sort of stuff. So there's nothing obvious that jumps off the page where the layperson would say, well, you know, I don't trust these people. Then when you get the overlays about, well, this has all been signed off by a KC or it's been signed off by these tax experts, where I do have a lack of sympathy for them is simply accepting those assurances and not asking to see the advice. Because if these firms are so confident of that, there is no real reason why that advice can't be given to prospective clients if they ask for it. And it's the if they ask for it. Now, if they're trying to sell something to you and you ask to see the advice and they refuse, well, that to me is a clear red flag that you should just say, no, sorry, I'm not going to do that.
I think with both 118 and landlords, there is no advice. I mean, there's nothing. Yeah. It's just a note to say, here's a bit of a document, please sign it. And I think with one case with Let's Have Landlords, there's just a few emails. There's nothing been formally given as advice. So it seems to me it's just a very, very, very slick marketing. And they were promoted by the industry itself, you know, going to awards and this and that and being getting accolades of being the best accountancy firm as here and there and stuff. So it's all quite incestuous, but they all seem to operate in a very similar way. That the sales marketing side is never qualified in anything legal, accounting, tax, or bricklaying, nothing at all. And then they somehow latch on to somebody, normally in a remote part of the world, who's got a qualification, and try to, in effect, kind of become more respectable by doing that. But I suppose in a way, it's at least now with Dan's various emails, it's come to light. But it's still difficult to convince clients to do the right thing, because they're now kind of super confused now. Well, do we believe you or them? Or, it's quite hard to get across to them.
I think as well, I think we heard that somebody we've spoken to, they were obviously reticent to then pay out additional fees because they'd already paid out quite a chunk of fees. And one of the fees that they said that they'd paid was £3,000 for an introductory meeting. And this meeting was held at some offices where they were encouraged to, sign up. And I think it's coming back to your point earlier where people, if they're going to go to see a doctor or sell a house or whatever they're going to do, they're going to sort of do some kind of due diligence. But it comes to tax and the opportunity that you don't have to pay X by paying Y seems to completely trump any sensible thought patterns.
Yeah, that's true.
And I think that we have been really surprised at literally the thousands of pounds that people have paid out. It's like the Emperor's New Clothes. There's literally nothing there. And that I have been quite shocked and surprised by that.
It is almost completely inexplicable as to why people act like this in this particular context, because I'm struggling to think of any other aspect of a person's life where they would be so cavalier around accepting what people are saying to them. And if you go back 20 years, people could be forgiven. But in the last 20 years, there's been headline after headline after headline. There's been exposure of Jimmy Carr. There's been exposure of Gary Barlow. You had Lorraine's case all over the tribunal. You've had that recent case of Kay Adams where the revenue dragged her through the courts for year after year after year, only to eventually have to give up because it was quite obvious they were never going to win. So, people see all this kind of stuff, and yet they still, someone comes along and says, oh, well, if you do X, Y, Z, you can save all this tax, but it will cost you, this amount of money. And they still seem very keen to just sign up. And I mean, the revenue get a lot of criticism for their mantra that if it's too good to be true, it probably is too good to be true. And whilst generally I agree with that, there are aspects of the tax system that operate in a way that are too good to be true, but are perfectly legitimate. So, it's not something that holds absolutely, true. But I think it is a good rule of thumb. And again, we do it in our normal life. I mean, if someone came along and said, if you were wanting to sell your house and someone came along and said, oh, I'll do it for £100, you would look at it with real skepticism. And you'd think, or if someone said, oh, I'll do the legal work for your house purchase and it'll cost you £50, you'd think, or better still, I'll do the legal work for your house and I'll actually get you more for your house than you originally got. That would probably... And that'll cost you £3,000, So
a client recently, I think, that where they sent a kind of a strongly with an email to me saying, "Oh, we've claimed back £50,000 worth of VAT that we shouldn't claim back." I said, "What do you mean? On what deal?" Okay, who said this? Oh, we've got some external advisors came in. I said, okay, fine. I assume you got some kind of letter or report or to look at. No, it was on doing a Teams call. I know, I got the name out. I checked them out. They weren't qualified. They're just some random people in Kent who do VAT reclaims or, they're just, these are clever clients, but they just get bamboozled with certain things.
I mean, years ago, I had a business client who wanted to issue shares that came with an EIS. And I said to the client, well, you don't qualify. Well, why don't we qualify? I said, because the company's held by a holding company. So you just can't do it that way. And I said, well, he said, well, what's the answer? And I said, well, look, if you're prepared to accept me, we could write to the revenue and we could just ask them to confirm whether or not you qualify. Oh, well. So anyway, that got left. One day at the blue, he phoned me up to say that a firm had advised them that they do qualify. And I said, well, on what basis? And they said, well, said they're quite happy. The holding company doesn't matter. I said, but the holding company does matter. I said, outside the UK, and it's held by a trust, and you just, the only way you can make it is to completely reconstruct your group structure. Oh, no, he said we can do it. So I said, well, if they can do it, let them do it. So anyway, off he went. And about a year later, he phoned me up and he said, do you remember that I wanted to get those EIS shares? I said, yeah. He says, well, we did that and we issued all the shares, but now the firm have come back to me and said that we don't qualify because they found out about the holding company and the trust and so on. And they wanted me to fix it.
Yeah, but again, it's just doing revision.
Sorry,
look at the structure. Who owns? First question. Who owns the shares? First question.
So you've got a firm coming along who are holding themselves out as experts in EIS, and they don't do sufficient diligence of their own to identify the structure that they're dealing with, and they give the client rubbish advice. And the client then ends up in a situation where they've got to withdraw all the claims and explain to their shareholders and so on. So
that's schoolboy stuff, isn't it? That's a schoolboy stuff.
And
I could go on for hours.
And yet, when you look at most tax planning, when it goes wrong because of something basic. It tends not to be something really, really complex part of the analysis. It's always something basic that goes wrong in the vast majority of cases. And if you look at the Property 118 and the less tax for landlords and all that sort of stuff, it's basic stuff. I mean, the point that Dan picked up originally was this issue with the mortgages, but not transferring the mortgages into the company and so on. Now, that's a kind of basic point that a good quality property lawyer would have said, yes, but you need to do something about them, or you need to tell your bank that you're moving the properties because that's what you've got it secured on. And that would have then presented a barrier, not insurmountable barrier, but it would have presented a barrier. But it's cheaper and it's easier just to pretend the barriers don't exist.
But I mean, I think with them, that was why they never really involved solicitors, because at that point would have been picked up instantly. I mean, I was on a course probably 3 years ago now, and they were talking about moving property around, and I actually raised on the course with this. It was run by Step actually, and said, well, what are you going to do about the mortgages? And they were like, well, that's not a point for the discussion now, but it must be a point for the discussion now, because if you're presenting something as a solution, it can't be a solution if it's only half a solution, because if you take this to a firm of solicitors and you were ever going to transfer these properties, they would say, well, what about the mortgage? And I just think that it's yes, it was a fundamental point really. It was never going to, irrespective of any of the other tax advice or lack of it, it was always going to fall there really.
I mean, just to finish that point off, I mean, where they compounded it was the response to Dan Needle wasn't, dear Dan, you're wrong for all these reasons, or dear Dan, yeah, we accept that there is this and that can be fixed. It was to attack his credentials, to criticise him. And again, the last thing you're going to do if you actually know who Dan Needle is, you're going to attack his credentials to advise on tax or to make, to express opinions on tax. Now, okay, he's not a member of the Chartered Institute of Taxation, but I'm pretty certain he knows as much about tax as any member of the Chartered Institute of Taxation would be expected to know. So, and it's hugely experienced. I mean, you don't become the position that he held unless you really know what you're talking about. So it was madness to just simply try and attack Dan's credentials.
Yeah, agreed. So in terms of coming full circle, so we've so in terms of regulation, then it's going to be very difficult to, as it always is, to regulate promoters.
There's two aspects to it. There's how do you regulate advisors so that they give quality advice, and that's not about whether they make mistakes, because everybody makes mistakes. It's human nature. Everybody will make a mistake, no matter how good they are. And the other side of it is how do you hold advisors to account when they do bad things, when they promote abusive tax schemes, when they give advice which just has got no foundation in it at all. And you see within the way the professional bodies work, they have a set of standards, they have a set of rules, and if you transgress, then you can be held to account. In the CIOT and ATT, it's through the taxation disciplinary Board, the ICAW, the Law Society, the SRA, they've got all their own different arrangements that they do that. But the fact of the matter is that there is no general scheme whereby you can hold an advisor to account outside of that structure. So the 30, 40,000, however many it is, individuals who are outside of those types of structures, they're in a position where the only way they can be held to account is if a taxpayer sues them or a client sues them. And, well, you know as well as I do how rare that is. And in most situations, I think it would be fair to say the courts have been generally sympathetic towards the advisor, which is perhaps from a public policy perspective, the right way for the court to be, that the taxpayers got an uphill struggle to actually prove that the advisor gave them, sufficiently bad advice as to pass the bar or cross the bar into being negligent or worse. So it's a complicated area. The thing that's frustrated me is we haven't really even got off first bat when it comes to the sort of non-professionally qualified advisor. There's absolutely nothing beyond anti-money laundering rules, which themselves are not unimportant, but beyond the anti-money laundering rules, there's nothing which impacts on a non-professionally qualified advisor. And it gives them a big advantage in the market in the sense that they can obviously, they're not exposed to insurance costs, they're not exposed to the costs of maintaining professional body membership and so on. And that then feeds through into what they can charge the clients. But equally, operating in the situation where there is no control over them, they don't have to, make annual returns and so on. And they don't have to live up, I suppose it sounds a bit grand, they don't have to live up to the professional ideals of being a member of a professional body. And it's always been important to me, and I'm sure it's been important to you, Amanda, to be a solicitor, and you, Simon, with the professional stuff that you've done, that, you're part of that group. And, there is a sense, well, certainly there's a sense in my mind, you don't want to let it down.
You work hard in your profession, you study for it, you pass the exams, and then over the years, I've been in 30 years in practice, so you kind of get to a stage where it irks me to see these kind of things still going on, and it irks me. I mean, even the people still selling loan schemes by umbrella companies, that should have been many years ago, but some people still fall for it, and I don't know what it is, whether it's just I don't know why people thought
it goes back to the point. It goes back to the point we discussed earlier, that people's eyes glaze over, and when they hear you'll pay less tax. Two most magical words in the English language are less tax. Hence less tax for landlords. It's all deliberate. When I was president of the CIT, we have the new members ceremony twice a year, and one of the points that I made one year, to the 200 or so very young, very eager, very enthusiastic new members of the Institute, was that at some point in your career, a client will pressure you to do something that the little voice in the back of your mind is telling you, it's not right, or it's not entirely right, and you'll hesitate as to whether or not you tell the client that it's not right. And obviously at the earlier part of your career, that's more difficult than I mean, as you know, I never slow to tell clients, where to get off in terms of, when they want to do something mad. And the point I made to them was that when the day comes and they're in that situation, one possible way to think about it is to think back to that point when they were getting the new member ceremony and they were there with all the families, and think how important that was to them and what an achievement they had achieved in getting to that stage, and then asking themselves, is it worth potentially throwing that away to follow through with something? Because, at the end of the day, the client will blame you. I mean, in every situation where it goes wrong, the client will look to blame the advisor. And I mean, generally, I've never really been in situations where I've given just pure advice. Most of the time, I'm involved with clients where they've got some HMRC problem. So it's always sort of looking back. There have been very, very few situations at the time since I left HMRC where a client has actually acted, and done a transaction just on the basis of my advice alone. But I'm pretty sure that in those situations, if it had gone wrong, it would have been my fault. And it wouldn't matter what the problem was, it would be the advisor's fault. So So there is that. I mean, I've always liked that that idea, that quote that, you know, if someone's got to go to jail, make sure it's the client. You know, I think it is. I think it is quite good advice.
Yeah.
and basically, I read it that you should always act in a way that there is no possibility of you going to jail. And you know, having been in situations during my review time where I went out with search teams and arrested barristers and various other people and terrorised solicitors because, you know, it became obvious to them that they were suspect in a fraud and all that sort of stuff. You can see the impact, you know, on professional people when suddenly the quality and the integrity of their work is called into question. Oh, yeah. But as I say, we haven't even got off first base when it comes to how we try to regulate. And I think regulation of people who are members of professional bodies, and regulations of CIT members, ATT members, members of the Law Society, members of the Bar Council, all that, I think that that's a second order thing. I think it's less important than trying to get some kind of regulatory framework around people who are, you know, not professionally qualified, who are in effect giving tax advice, no matter how it's dressed up, but they are giving advice, or they are, you know, giving details to a taxpayer that's allowing that taxpayer to carry out a transaction that may be non-compliant or worse. And as I say, we haven't even got off first base with that population. And, you know, even something as simple as making it a requirement that someone who is giving advice has to be registered with whoever, HMRC, you know, the NCA, anybody. And then, you know, having a situation where that person can be held to account. And I don't think it would be going too far to make it a criminal offence to give tax advice in situations where you hadn't actually registered. I mean, the registration wouldn't actually really need to mean anything beyond that. It wouldn't be a check. But if you don't go right at the start, I'm going to set myself up as a tax advisor, who do I register with? And the answer is, well, nobody. I mean, that just doesn't sound right. And I mean, a few years ago, John Cullinane, who was the tax policy director of the CIT, and I met a really senior BBC journalist who almost fell off the seat when we explained to him that, you know, a tax advisor didn't need to be formally regulated by anybody and didn't need to be a member of a professional body. So, I mean, that's fundamentally, crazy. It's just not good enough.
I think it was some kind of reserved work tax advisory where they can just be done by someone of a qualified body. I think not everything, a bit like the lawyers do, but I think there needs to be something there. You can't just turn up, get a nice sign outside, neon sign next to the kebab shop, and then say, "Okay, come here for your tax return advice," which is what you can do.
Yeah, and I think that is the case. Is that, and often, you know, we've found that people will have said, "Well, our tax advisor has said," or "Our lawyer has said," and actually, they really are neither. Not in a sort of a regulated or professional or qualified sense at all. And I think they've been enabled. I think this idea that you could open up the competition to every man and his dog, you know, I mean, certainly from a solicitor's point of view, it was, you know, co-op could start doing wills and probates and all that sort of thing. And it was important to open up the market, but I actually think it wasn't. It was managed, it was regulated, it was professional. And then you kind of opened it up to every Tom, Dick and Harry. And yeah, you have unregulated people that are not governed by the same rules and therefore the same standards. That is a problem.
Yeah, when I was discussing it with various people in Treasury and so on, one of the big things that was being put to me was a concern within government about pricing people out of the market. And I thought, well, okay, it's not an illegitimate concern, but it's a concern that you have to actually look at wide open. Lots of people, millions of people are priced out of the market as it stands. Yeah, I mean, the idea of having to get, you know, tax advice, I don't think that that's particularly appetizing to most people, because tax advice is quite expensive because, you know, professionally qualified tax advisors, their work is valuable. So, you know, the vast majority of people in this country don't get tax advice from anyone. And I think if you've got an advisor who's got 50 clients, say, and that person's not, you know, professionally qualified, and the government comes along and puts some regulatory framework on them, requires them to have insurance or to do CPD or anything, whatever it is, or even just registering that they're, you know, tax advisors, that's got a cost attached to it. But when you spread it across the client population, the individual cost is neither here nor there. But the fact remains that those who can't afford tax advice will still not be able to afford tax advice no matter what the government does. The only way you could change that would be for the government to subsidise the cost of getting tax advice. So I've never really been sympathetic to that argument, or more precisely, I've never felt that that in itself was a reason to not do anything. And the simple truth of the matter is, apart from anti-money laundering, which itself gets a lot of objections from advisors, the government haven't really done anything to try and get us into a situation where, tax advisors, people who are giving tax advice, I think is probably the better way to put it, can be held to account. And I say I'm less bothered about the day-to-day regulation. I'm more bothered about the lack of ability to hold people to account when they're found to be acting badly. Because I think no matter what we do, HMRC can never be on top of everything that's going on. In the same way that, you could have a member of the Institute, you could have a member of the Chartered Institute who's misbehaving. And it only comes to light if someone complains about him or her, or the Institute itself finds that they're not complying with money laundering rules or something like that. And you can't live in people's pockets all the time. So there has to be a large element of trust. But equally, there has to be a mechanism to hold people account when they act badly.
Yeah.
Yeah.
Well, that was a fascinating conversation. Thank you very much. I think for takeaway for people listening is, I think the same drum that we've been beating for a while is you can't just do nothing. And
doing nothing is not an option.
Yeah.
Doing nothing is not an option.
Well, thank you very much for your time today, and we look forward to speaking to you again.
Great to see you, Amanda. You too, Simon.
Thanks, mate.
Thanks very much.
Cheerio.
Cheers.
Bye-bye.
Bye.
Thanks for listening, and tune in next time when we discuss more of the tax and legal issues surrounding your business and property needs.